We've always talked about, Ashish, the importance of asset allocation, rather than putting all your money in just one asset class, whether it's equity or it's debt or which includes fixed income, which is what people tend to do. Is this the time when actually the importance of asset allocation is coming out to the fore? Because imagine if you were, say, 60-40, 60 in equity and say 40 in debt, while you've seen a very sharp cut in equity, the same is not true as far as debt is concerned, and that's probably cushioned the fall. And there's enough data to suggest that if you had done an asset allocation, you would have probably performed much better on your portfolio than if you were only in one particular asset class. Is this the time where, for people who have not thought of this and preferred to go into only one asset class, it's the right time to tell them of the importance of asset allocation? How is that playing out?
Yes, every once in a while, like I said, every once in 5 years or 10 years, when the market actually goes down like this, is when you really realize that, had you actually balanced your portfolio across asset classes, may it be equity, may it be fixed income, may it be gold, may it be international equity, or whatever the asset classes one can consult with their advisors. I think these are the times when you realize the importance, for two reasons. First is that when the market falls, obviously a balanced portfolio between debt, equity, etc., that obviously falls lesser. And now the second part, which is actually even more important, which is that when the asset classes, when it falls in value, when equity falls in value, at least if you have some money in debt on the side, you'll be able to withdraw something from debt, and then you'll be able to take advantage of lower equity values. So it's a double whammy a lot of times. If you are not well allocated, it can be double whammy, because you fall more, and second, you can't even take advantage of the lower prices, because everybody doesn't have money lying in their current account and saving account. So how are they going to take benefit of these prices? The second thing is, exactly when these things happen, investors tend to ask portfolio managers like us, why weren't you holding cash? Now look, what debt, what equity, what is to be owned in clients' portfolios, we are actually quite opaque to what the end client has in terms of his allocation. And frankly, when the market travels from 12,000 to 7,500, everybody thinks, why didn't you hold cash? But when 7,500 becomes 9,000, the way it's becoming now, then again, we will look foolish. So we don't want to get whipsawed on both sides. I think taking cash calls, taking asset allocation calls should not be expected from an equity fund. And lastly, how I would put it is that the least you can do is then to be in a balanced advantage or a dynamic fund, because then nobody is to get into asset allocation. These are all calibrated with the certain indicators of valuation, and the equity exposure gets calibrated automatically. So that's the least you can do actually, if you at least don't do asset allocation appropriately.
Always a pleasure talking to you, Aashish Somaiyaa. Thank you very much for joining us here on the Money Mile, and wish you good luck, stay safe, and all the very best.
Thank you for having me. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.